Ray Dalio stared at the demographic analysis spread across his desk, his hands trembling as the full magnitude of what he was seeing sank in. It was 4:23 a.m. at Bridgewater Associates, and what he had just uncovered would either save an entire generation or confirm the greatest financial disaster in human history. The numbers were devastating. Over the next 5 years, the largest intergenerational wealth transfer in history was about to begin, with baby boomers preparing to pass down over $70 trillion to their children and grandchildren. But Ray's analysis showed something that no one else had calculated. Generation Z was catastrophically unprepared to receive this wealth, and they were going to lose most of it within a decade. Ray had been working on this analysis for 3 weeks, initially as an academic exercise to understand generational investment patterns. What he discovered was so disturbing that he had run the calculations 17 different ways, hoping to find an error. There wasn't one. The data painted a terrifying picture. Generation Z, those born between 1997 and 2012, had grown up during the greatest bull market in history, but had learned about investing from TikTok influencers and Reddit forums rather than from proven financial principles. Their investment behavior was driven by social media trends, meme stocks, and get-rich-quick schemes that defied every principle of sound financial management. Ray's most recent case study haunted him. A 25-year-old from Austin had inherited $1.8 million from his grandmother's real estate investments. Within 4 months, he had lost 94% of it following day trading advice from a 19-year-old TikTok influencer who had never taken a finance class. The grandmother had worked 2 jobs for 40 years and lived in the same modest house to build that wealth. Her grandson had destroyed 4 decades of sacrifice in 16 weeks. Ray pulled up the most damning piece of evidence, a comprehensive analysis of Generation Z investment behavior over the past 3 years. They had poured billions into cryptocurrency speculation, meme stocks like GameStop and AMC, and day trading platforms that marketed investing as gambling. The success rate was abysmal. Over 90% of young day traders lost money, yet the behavior was accelerating. But the real crisis wasn't their current losses. It was what would happen when they inherited the wealth that previous generations had spent decades building. Ray's models showed that at current spending and investment patterns, Generation Z would dissipate 85% of their inherited wealth within 10 years. The psychological profile data was equally disturbing. Ray had commissioned a study of financial attitudes among 18-30-year-olds and discovered that 73% believed they were smarter than previous generations about investing because they had access to real-time information and social media advice. They didn't understand that information without wisdom was dangerous, and that social media algorithms were specifically designed to exploit their psychological biases for profit. Ray walked to his office window, looking out at the pre-dawn darkness over Connecticut. He thought about his own children and grandchildren who would be part of this demographic disaster. How had an entire generation become so financially illiterate, despite having access to more information than any generation in history? The answer was disturbing. Ray's research showed that social media algorithms had created echo chambers where young people received financial advice from influencers who were themselves financially illiterate. TikTok financial gurus with no formal education were giving investment advice to millions of teenagers who trusted them more than traditional financial advisors. Ray had documented specific examples that made his stomach turn. A 20-year-old cryptocurrency influencer with 2.3 million followers had been promoting a token that turned out to be his own creation. When it collapsed, he had stolen over $50 million from his young followers and disappeared. Yet similar scams were launching daily, and young people continued to fall for them at unprecedented rates. Ray picked up a folder containing the most shocking data, a comprehensive study of financial influencer accuracy. The so-called experts that Generation Z followed on social media had a success rate worse than random chance. Yet their follower counts were in the millions, and their advice was being taken as gospel by young people who would soon inherit trillions of dollars. The demographic analysis revealed something even more terrifying. The wealth transfer wasn't evenly distributed. The children and grandchildren of America's wealthiest families were just as susceptible to social media financial manipulation as everyone else. Ray had identified dozens of cases where heirs to family fortunes worth hundreds of millions were making catastrophic investment decisions based on influencer advice. The secure phone on Ray's desk buzzed. It was a message from his research team. Ray, you need to see the latest data on crypto influencer bankruptcies. This is worse than we thought. Ray opened the encrypted file and felt his blood pressure spike. Over the past year, dozens of cryptocurrency and investment influencers who had been advising Generation Z had quietly declared bankruptcy or been exposed as frauds. Sam Bankman-Fried's FTX collapse had been just the beginning. The young people who had followed these influencers had lost billions, yet the influencer economy continued to grow. What made the situation even more insidious was that the platforms themselves were profiting from the destruction. Ray had discovered that TikTok, Instagram, and YouTube were all taking advertising revenue from financial services companies that specifically targeted young people with high-risk investment products. The platforms knew their algorithms were promoting financial misinformation, but the engagement was too profitable to stop. Ray began typing what he knew would be the most controversial analysis of his career. The document was titled The Great Generational Wealth Destruction: How Social Media Will Cost Generation Z $70 trillion. But before he could complete the first paragraph, his secure phone rang. It was Warren Buffett. Ray, Warren's familiar voice came through the encrypted line. I assume you've been seeing the same data I have about young investor behavior. Warren, it's worse than either of us imagined. I've been running comprehensive models, and we're looking at the complete destruction of intergenerational wealth transfer within a single generation. Warren was quiet for a moment. Ray, I've been investing for 70 years, and I've never seen anything like this. These kids are treating the stock market like a casino, but they don't understand they're gambling with their family's life savings. Warren, the math is devastating. $70 trillion is about to change hands from the most financially disciplined generation in history to the least financially literate. My models show they'll lose 85% of it. Ray, what's driving this behavior? In my day, if you wanted investment advice, you went to professionals who had track records and fiduciary responsibilities. Now, these kids are taking advice from teenagers on TikTok. Ray had been studying exactly this question. Warren's social media algorithms reward engagement over accuracy. A 22-year-old who makes outrageous claims about 1,000% returns gets millions of views, while a seasoned advisor giving sound advice gets ignored. The platforms are literally programming an entire generation for financial failure. Ray, I've been trying to reach young people through traditional media, but they don't consume traditional media. They get all their information from social media platforms that prioritize entertainment over education. How do you compete with that? Warren, that's exactly the problem I'm trying to solve. We need to understand that we're not just fighting financial illiteracy, we're fighting the most sophisticated behavioral manipulation system ever created. These algorithms know exactly which psychological buttons to push to make young people feel smart while making catastrophically bad decisions. Ray, what kind of timeline are we looking at for this disaster? The wealth transfer accelerates starting this year and peaks in 2027. Based on current behavioral patterns, the wealth destruction begins immediately and is irreversible by 2030. Warren, we're talking about the end of family wealth accumulation that took generations to build. After ending the call with Warren, Ray sat alone in his office, grappling with the moral implications of what he had discovered. Should he publish his analysis and risk triggering the panic that could accelerate the very disaster he was predicting? Or should he stay silent and watch an entire generation destroy their economic future? Ray's internal conflict was intensified by a personal dimension that he hadn't shared with Warren. His own granddaughter, Emma, was 23 years old and had recently started investing her trust fund distributions based on advice she received from financial influencers. Despite Ray's attempts to educate her about sound investment principles, she dismissed his advice as outdated and continued following social media gurus who promised unrealistic returns. Just last week, Emma had lost $50,000 in a cryptocurrency scheme promoted by an influencer who turned out to be running a Ponzi scheme. When Ray tried to discuss what had happened, Emma became defensive and accused him of not understanding modern investing. The conversation had ended with Emma storming out, saying she would rather lose money on her own than make money using boomer strategies. Ray opened a new document and began outlining the specific behaviors that were driving Generation Z toward financial ruin. The list was extensive and terrifying. Day trading addiction fueled by commission-free platforms that marketed investing as entertainment. Young people were treating stock trading like video games, making dozens of transactions daily based on social media tips rather than fundamental analysis. The platforms had gamified investing with confetti animations and achievement badges that reinforced addictive behavior. Cryptocurrency speculation driven by fear of missing out rather than understanding of blockchain technology. Surveys showed that 67% of young crypto investors couldn't explain how Bitcoin actually worked, yet they had invested significant portions of their savings based on influencer recommendations. Ray had documented cases where young people had taken out student loans to invest in cryptocurrency, creating impossible debt situations when the investments failed. Credit card debt accumulation to fund investment speculation. Ray's data showed that increasing numbers of young people were borrowing money to invest in high-risk assets, creating a catastrophic combination of leverage and inexperience. Credit card companies were actively marketing cash advances for investment purposes, knowing that young people would use the money for speculation. Complete rejection of traditional investment principles. Time-tested strategies like diversification, dollar cost averaging, and long-term thinking were dismissed as boomer advice by a generation that expected instant gratification. Ray had found that many young investors couldn't even explain the concept of compound interest, despite it being the foundation of wealth building. The secure phone buzzed again. This time it was Jamie Dimon from JP Chase. Ray, I've been reviewing our internal data on young client behavior, and it aligns with everything you've been researching. We're seeing 25-year-olds day trading their inheritance money and losing it within months. Jamie, what are you seeing at the institutional level? Ray, it's a disaster. We have clients in their 70s who've spent decades building wealth through disciplined investing and saving. They're watching their adult children burn through money faster than they can transfer it. Some are actually changing their estate plans to delay transfers because they know their kids will lose everything. Jamie, have you calculated the systemic implications if this continues? Ray, if an entire generation loses their inherited wealth, we're looking at a complete breakdown of the American wealth building model. No retirement security, no generational wealth accumulation, no capital for business formation. It could destroy the foundation of the American economy. Ray felt the weight of the conversation crushing down on him. This wasn't just about individual financial mistakes. It was about the potential collapse of the entire American economic model that depended on intergenerational wealth accumulation. Jamie, I've been thinking about potential interventions, but every option seems to have unacceptable trade-offs. If we push for regulation of financial influencers, we risk being accused of censorship. If we require financial education, young people will just ignore it like they ignore everything else from traditional sources. Ray, there might be another approach. What if we could work with the social media platforms themselves to change their algorithms? Instead of promoting get-rich-quick schemes, they could promote sound financial education content. Ray had considered this possibility, but his research into platform incentives was discouraging. Jamie, the platforms make money from engagement, and sound financial advice is boring compared to promises of overnight wealth. A video explaining dollar cost averaging gets 10,000 views, while a video promising 500% returns gets 10 million views. The economics don't support responsible content. After ending the call, Ray spent the next 2 hours reviewing case studies of specific wealth destruction incidents. The stories were heartbreaking and infuriating. A 24-year-old in Silicon Valley who inherited $2 million from his grandfather's technology investments, then lost 90% of it day trading based on Reddit recommendations within 6 months. The grandfather had been a disciplined investor who had built the wealth over 40 years by consistently investing in blue-chip stocks and holding them long-term. A 26-year-old in Miami who received a $500,000 trust fund distribution and immediately invested it all in a cryptocurrency promoted by a TikTok influencer. The coin turned out to be a scam, and she lost everything. When confronted by her family, she borrowed another $100,000 against future distributions to try to make back her losses, creating a debt spiral that consumed her entire inheritance. A 23-year-old in New York who borrowed against his expected inheritance to invest in meme stocks, creating a debt spiral that forced his family to sell property that had been owned for generations. The family had immigrated from Ireland in the 1920s and had slowly built wealth through real estate investments and small business ownership. 3 generations of disciplined saving had been destroyed by one generation's speculation. These weren't isolated incidents. Ray's research showed that similar stories were playing out across the country as the first wave of wealth transfers began. The pattern was consistent. Young people received money, immediately invested it based on social media advice, and lost most of it within months. Ray's computer chimed with a priority message from his demographic analysis team. Ray, we've identified the accelerant factor. Social media gambling platforms are specifically targeting young inheritance recipients with personalized ads. They're turning wealth transfer into a customer acquisition strategy. Ray opened the attached report and felt sick. Major financial platforms were using data mining to identify young people who had recently received inheritances, then targeting them with aggressive marketing for high-risk investment products. The platforms were literally farming the destruction of generational wealth for profit. The targeting was sophisticated and predatory. Platforms were monitoring social media posts for keywords like inheritance, trust fund, and family money, then using that information to serve personalized ads for cryptocurrency exchanges, day trading platforms, and speculative investment schemes. Young people who posted about receiving money were immediately flooded with content designed to separate them from their wealth. The phone rang again. This time it was Christine Lagarde from the European Central Bank. Ray, we're seeing similar patterns in Europe. Young people are inheriting family wealth that survived 2 world wars and losing it to cryptocurrency scams and social media trading schemes. It's not just an American problem. Christine, what's the scale you're seeing? Ray, our analysis suggests that European millennials and Gen Z investors will lose approximately 15 trillion euros over the next decade through speculative investing and financial illiteracy. But the social causes are identical. Social media misinformation and rejection of traditional financial advice. Christine, are European authorities considering any interventions? That's exactly why I'm calling. Ray, your analysis is being circulated among central bankers worldwide. The question is whether this is a market failure that requires regulatory intervention or a generational learning experience that we should allow to run its course. Ray realized that his private research was being treated as intelligence by financial authorities around the world. The scope of the potential disaster was so vast that it was being discussed at the highest levels of international finance. Christine, the challenge is that any intervention could be seen as paternalistic. These are adults making their own financial decisions. But Ray, when those decisions threaten the stability of the entire financial system, individual choice becomes a systemic risk. We're not talking about people losing their own money. We're talking about the destruction of capital that took generations to accumulate. After the call, Ray walked to his bookshelf and removed a historical analysis he had written years earlier. The Destruction of Family Fortunes: How 3 Generations Build, Preserve, and Lose Wealth. It was his study of how family wealth typically lasted 3 generations. The first generation builds it, the second preserves it, and the third destroys it. But what he was seeing with Generation Z was different. The timeline was accelerating. Instead of taking 3 generations to dissipate family wealth, social media and modern financial technology were enabling young people to lose everything within months of receiving it. The historical precedent that most closely matched the current situation was the destruction of Russian aristocratic wealth after the Bolshevik Revolution. But even that had taken years to complete. Ray was documenting the destruction of American generational wealth in real time, and it was happening faster than any historical precedent. Ray made his decision. He would write a comprehensive public warning about the generational wealth destruction crisis, but he would also begin working directly with financial education organizations to develop emergency interventions. He opened a new document titled An Open Letter to Generation Z: How to Avoid Losing Your Family's Life Work. It would be his attempt to counteract the financial misinformation that was destroying young people's economic futures. But as Ray began typing, he realized the fundamental challenge he faced. How do you convince a generation that trusts TikTok influencers more than Warren Buffett that their financial behavior is catastrophically self-destructive? How do you compete with algorithms designed to make speculation feel like success? The answer came to him as he thought about his granddaughter, Emma. He needed to meet Generation Z on their own platforms, using their own communication methods, but with messages grounded in proven financial principles. It would require learning their language and their culture without compromising the fundamental truths of wealth building. Ray's secure phone buzzed with one final message that crystallized the urgency of the situation. Ray, just saw your preliminary analysis. My grandson is 22 and about to inherit $5 million from our family trust. He's already talking about putting it all into cryptocurrency because some influencers said traditional investments are for losers. Can you help? Not David Koch. Ray realized that even the wealthiest and most financially sophisticated families in America were facing the same crisis. Their children and grandchildren were rejecting proven wealth building strategies in favor of social media speculation. As Ray prepared to publish his warning and begin his campaign to save Generation Z from financial self-destruction, he couldn't shake the feeling that he might already be too late. The algorithms were too powerful, the influencers too persuasive, and the young people too confident in their financial illiteracy. But he had to try. The alternative was watching the greatest accumulation of wealth in human history disappear in a single generation, destroyed by the very technology that was supposed to democratize financial information. The greatest wealth transfer in history was about to become the greatest wealth destruction in history. And Ray Dalio might be the only person with the knowledge, credibility, and courage to try to prevent it. Whether Generation Z would listen to him remained to be seen, but he had to try. The $70 trillion disaster was beginning, and time was running out to prevent the complete destruction of American generational wealth. Ray Dalio was about to discover whether financial education could compete with the most sophisticated misinformation campaign in history. As he began drafting what might be the most important financial warning of his career, Ray knew that the fate of not just individual families, but the entire American economic model hung in the balance. Generation Z was about to inherit the world, but they were catastrophically unprepared for the responsibility. The question was whether anyone could save them from themselves before it was too late.